But before we get into this video, I want to show you guys a video clip on a recent interview with Warren Buffett that really just opened my eyes on how American businesses have evolved and how the quality of life throughout America's history has just gotten better.
Can we talk about the global economy then, in terms of
Well,
where we are?
I can tell you where we are, but
let me phrase it this way in terms of the global economy. I mean, you look at the United States.
United States economy, and it's very easy to look at the statistics on it. I mean, more people, a greater percentage of the American population is wealthy now, or having more income now than they've ever had. And if you look at whether Bank of America will give you their average deposit, I mean, you just look at the wealth and that doesn't mean everybody's wealthy, but it does mean relative to any other period of time. Bottom 2% in terms of income in the United States, the bottom 5%, and for sure the top 1%, all live better than John D. Rockefeller was living when I was 6 years old. John D. Rockefeller was the richest man in the world.
There were some things in this clip that I didn't share with you guys that we went through as a country that we got through as well. Whether that's the pandemic, whether that's 9/11, whether that's the Great Depression. There's so many things that Americans have been through, and we tend to get through them. We tend to get through these hard times. And throughout history, it has shown that you do want to invest through these hard times because that usually presents great buying opportunities and creates long-term wealth. First thing I always like to do is kind of get an idea of where price targets are for any stock. That way there, I know if I'm coming in pretty close, below, above when I start running my analysis. So the first thing is what are the experts saying about Chipotle? What's the sentiment on this around the stock? And the low on Chipotle is $1,500, while the high is around $2,500. Giving it an average price target of roughly $1,800. The stock is currently sitting at $1,400. Now, before we get into the nitty-gritty of Chipotle, let's just briefly touch on their business model. Now, Chipotle is a Mexican-style fast food chain that is now global, focused on customization of burrito bowls, burritos, tacos, and other Mexican-style dishes. Thing I personally like about Chipotle, guys, is that when you look at it from a price standpoint, I think an average bowl costs between $11 to $15 roughly. You're getting clean proteins, you're getting carbohydrates, you're getting fats. And so when I look at what you're getting for $11 to $15 in a bowl at Chipotle, and we compare that to kind of the fast food industry overall, I tend to believe that the quality of Chipotle, the ability to create a healthier dish within Chipotle's business versus the limited items that you have at a McDonald's. For me personally, if I had to choose, it's from a price standpoint, they're all pretty close. And from feeling full and getting a complete balanced meal, I tend to lean towards Chipotle. Now that's just me. But with that being said, I do like a greasy burger here and there, just like anybody else. But for me personally, if I had to choose on a consistent basis, I'm probably going to lean towards a Chipotle over a McDonald's, Wendy's. Might pick Five Guys over them, but bias in their business as far as the quality and price points, I think it's very on point, and I think it's going to be a very competitive and growthy business still going forward. So next, we look at the valuation of the company, trading at a 48 PE ratio. Now, obviously, this is going to be inflated when we compare this to their peers, but let's just take a look at what analyst growth rates are expected to be for Yahoo. So over the past 5 years, the company has grown 39%, and over the next 5 years are projected to grow pretty darn close to 30%. So that's very, very impressive if they can maintain that growth, especially when we factor in that we're in an economic downturn here. So I would probably be very cautious in running my numbers. Let's take a look at what other analysts are expecting from Chipotle. So when we look at stock analysis, they're actually looking to grow roughly They're looking to grow closer to 15% over the next few years, and that's about what I would project out. I'd probably project 12%, 10%, and 7%, as I think they're in this interesting point where they're not in a mature phase of their business. I think they're still in a growth phase, but that growth is slowing down, meaning that once we start reaching these $9 and $10 billion revenue, it's going to be really hard to go from 10 to 20. So that's why I'm going to limit my growth rates to kind of something that I see sustainable over the next few years. and factoring in that we are probably undershooting because we are going to go through some tough times here. And growing business in a tightening economy is definitely difficult as there's more capital restrictions and there's a consumer that's probably less likely to go out and spend. But if they do spend, I tend to believe they would be spending on something like Chipotle. So therefore, there is some defensiveness with this company in my opinion. Now, currently, like every other stock in the stock market this year, Chipotle is down for the year, which could lend a good buying opportunity on some recent dips. When we take a look at their valuation, the trailing 12-month PE, as we stated, is in the high 40s, and we compare that to the sector median of 10. Now, I don't necessarily think that this is accurate because when we compare it to like a company like McDonald's, who's always trading for a premium, Chipotle is not that far off from a company like McDonald's. I tend to believe that it should be trading for a substantial premium. 4 times, not necessarily, but when we compare it to McDonald's, it's definitely closer to being in line. So when we bring it down to an enterprise value to EBITDA multiplier here, we get about a 30 EV to EBITDA multiplier here. When we compare that to industry standard of 9, obviously, once again, very, very rich premium here. But let's throw McDonald's up there just to kind of get an idea of what they trade for. And when we look at McDonald's EV to EBITDA, it's in the 20s, and that's about where I want to put Chipotle's EV to EBITDA, as they're going to outgrow the competition here. Let's go back to Chipotle once again. They do have a premium growth rate compared to their competitors, and that's why I think we can get a little bit of a higher multiplier on there. And the reason why I'm contracting down is that we are in a contraction period of an economic cycle, and multiples are going to compress here. So I want to stay ahead of that and build some safety within my analysis here. So I'm going to use a 15 to 20 EV to EBITDA multiplier, because if we go through the last few years of Chipotle's EV to EBITDA, we can see it was trading at 211 and now is at 32. So I'm going to contract this down. We can see what direction it's heading in. The question becomes, at what multiplier does it kind of find a home? And I think it's going to be between 15 and 20, as that's a little bit of a premium above industry standard, but it's also below kind of your McDonald's. So I think eventually, once this becomes a mature company, we're going to find that that's where the EV to EBITDA multiplier is going to probably lie. So now here's the art in where a lot of people make mistakes. Running analysis is definitely a subjective exercise, so you want to really just be as unbiased as you possibly can. Let the numbers fall where they may and analyze from that standpoint. So I'm going to use revenue growth of 11% from years 1 through 3, 9% years 3 through 6, and I'm going to keep the 7% years 6 through 10. EBITDA margins have been expanding. 3-year average on their EBITDA margin is 11.68, but we can see that in 2021, it's went from 14, and even in 2022, it has expanded to almost 16% EBITDA margins, which is pretty strong here. So I think what I'm going to do is put it at 14 from years 1 through 3, 16 from years 3 through 6. I tend to believe that the trajectory of their EBITDA margins are heading into a positive direction, as we can see through history. And I'm going to project that out even farther as they scale bigger. Using very, very conservative growth rates and going off of kind of the just double-digit steady growth rates here, we get a price target of roughly $603 and a future value of 2030 of $1,300, which means that this is extremely overvalued. But if we use the growth rates that we get from Yahoo, it's going to be a whole nother story here. Now, Yahoo is projecting out nearly 30% growth rates for the next 5 years. And I'm going to use 20, 15, I'm going to use 20, 12, and 7% growth rates to see what happens at that point in time. And we get a $832 price target with an $1,800 future value in 2030. Even though I thought this stock was reasonably priced here, it's really going to come down to multiple compressions. So oddly enough, I'm actually surprised Chipotle wasn't closer to a buy. I basically need the stock to get cut in half in order to justify a buy. As we saw the multiples compress throughout Chipotle's history, I still tend to believe that that's going to be the direction that it's going to be heading. When we compare it to its peers trading at a much lower valuation, I think it's only a matter of time before Chipotle ends up hitting a growth stagnation, and then it gets the multiple it deserves. And that's why I run my multiples very, very low, because if a company's not growing over 30% by most analyst expectations, I tend to pull the multiple down, as I do think it's going to end up hitting a growth wall and being compared more to its peers at some point in time. So in order to avoid that down draw that takes place and me being exposed to it, I tend to look further out and put that multiple on today, So that way there I build some protections. It might be a stock that I never take a bite out of, but personally I would rather build the safety because we can see here that running my personal analysis and my growth rates, that there is a 50% downside risk to this stock coming down. And at that point in time, it could be justified to come down to those levels, as that's where the peers are trading and that's where roughly McDonald's is trading. Now, granted, the growth rates are stronger with Chipotle. To give you guys just a few examples on how that works, we had companies like Intel that were very popular that traded for high multiples back in the day that now, 20 years later, are trading cheaper than they were back in the day because of the multiple compression that took place. So just because it might not happen this year or next year doesn't mean that it won't happen. It just means that it might take longer to take place because it's a popular name. Once the growth slows down or they have a couple bad years, it starts getting in line with its peers, and that's where you get that drawdown. So as always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.